Welcome. My name is James Sackey. I'm the marketing director for the Vant Group and your host for the quarterly Deal Pulse, where I'm interviewing top deal makers.
So I'm a partner with Blank Rome.
So in Escor, we are a direct lender.
For their insights and their feedback.
I think on some of the sell side, you've got some companies that are in a little bit of trouble now.
On what's going on in the transaction world. Let's get to it. Thank you for joining us today. I'm joined by my friend and colleague, Steve Bartz. He is a shareholder with Greenberg Traurig. Steve, it's good to have you on. Thank you for your time, and tell us about you and tell us about Greenberg.
Sure. Well, thank you so much for having me on. Yeah, pleasure to be here. My name is Steve Bartz. I'm a shareholder at Greenberg Traurig, and I help my clients make money by forming, buying, and selling and investing in businesses. And I do this by counseling and representing my clients in connection with mergers and acquisitions, joint ventures, and private placements. And so I work with clients in a variety of industries, and I do both buy-side and sell-side work. And I'm part of a team at Greenberg Traurig that has almost 3,000 attorneys worldwide in approximately 50 locations, 60 plus practice groups across a wide range of sectors. So honestly, if you're a client or a prospect and you're looking to raise money by selling equity in your company, you're looking to do a joint venture or an M&A deal that's large, complicated, has a cross-border transaction component to it, give me a call. I'd be more than happy to help.
Excellent. I didn't know you guys were 3,000 strong. That's pretty big. I didn't know that.
We're a shade under.
Yeah.
We'll be there soon.
Good deal. So let's get right to it, man. What are you seeing when it comes to deal flow? Is it increasing, decreasing, or flat?
It's a great question. I'd say right now we're sort of observing a nuanced shift in deal flow. Transactions are not just increasing or decreasing uniformly. Instead, they're really evolving, I think, in response to both market volatility and macroeconomic uncertainty. I think it's really all a matter of perspective. So M&A deal volumes are still below the high seen in 2021. This year's Q1 deal count was the lowest quarterly level since the onset of the pandemic in Q2 of 2020. The drop in deal activity was, I'd say, particularly acute in the lower and middle market. Deal value, on the other hand, was up considerably this past quarter as there was an increase in the number of billion-dollar plus deals. And I would say additionally on the fundraising side, which always kind of helps drive deal value and deal activity to some degree, USPE fundraising levels remained low in the first quarter of this year, and capital raised fell for the third consecutive quarter. So I'd say what's really notable is a change in the deal profile. So rather than like large transformative buyouts, we're seeing a lot more bolt-on acquisitions, joint ventures, and minority investments, with sponsors really focusing on companies with strong recurring revenues, resilient margins, and proven management teams. So long way of saying there's really a premium on quality and creativity in structuring deals is really at a high point at this juncture. Everyone's trying to bridge valuation and financing gaps.
That is pretty nuanced. I've got to say that's probably the most insightful response I've heard so far. So thank you for that. That's really good stuff. Honestly,
My pleasure.
I feel like we could dive pretty deep on that, but we'll avoid that for now. So how would you say buyer behaviors have changed in the last 90 days?
I don't know that I can necessarily pinpoint it to precisely 90 days, but in the past 90 days or so, I've definitely seen buyers becoming more cautious and data-driven, particularly in light of fluctuating economic indicators and market volatility. I think valuation expectations have shifted a bit, again, with buyers pushing for more conservative multiples, especially in industries that are facing headwinds. Financing remains expensive and can be difficult to obtain, so buyers are being more selective about the targets that they're pursuing and more rigorous, certainly, with their due diligence. I'd say buyers are definitely conducting a deeper due diligence dive, focusing heavily on operational resilience, cash flow stability, and the ability to weather potential downturns. And buyers are also demanding much more robust financial information from sellers these days, drilling down on customer and supplier dependencies, and also seeking greater contractual protections in the forms of reps, warranties, and indemnification.
Would you say that's across the board from small, medium, and large businesses, or maybe on one side or the other?
At this point, at least from my personal experience, I'd say it's pretty uniform. Another interesting element as well, another development, is that buyers are pushing for longer exclusivity periods. I think in part because, or fueled in part by the desire to do deeper due diligence. They're certainly trying to include more walkaway rights, greater flexibility in deal terms, increased use of earnouts and deferred compensation, something that we previously saw just after the downturn. And some, I'd say there's less appetite for risk and a greater focus on fundamentals.
I was going to say, it sounds like they're pulling out all the stops for hedging against making the wrong move.
I'd say oftentimes folks aren't necessarily looking to do the best deal. Everybody would like to, but they just don't want to do a bad deal.
Yeah, that makes sense. I think, especially right now. Are you noticing any particular red flags that are killing deals in the process?
Oh, let me count the number of flags that I've seen. Absolutely. I would say probably at the top of the list, unreliable or opaque financials. If a
Yep.
target cannot clearly demonstrate historical performance and realistic future projections, buyers tend to walk pretty quickly these days. Second one would be customer concentration. It's an issue. Buyers tend to be wary of targets that are heavily dependent on a small number of clients or contracts. Legal and compliance issues such as unresolved litigation, regulatory investigations, or sometimes, depending on the nature of the target, weak IP protection can also still cause deals to stall or collapse.
Yeah.
Unclear seller growth strategies can also erode buyer confidence, depending again on the nature of the target and the rationale for the deal. Cultural misalignment between buyer and seller teams is increasingly being identified as a potential deal breaker, especially in transactions where integration is critical to success. And then I'd be remiss if I didn't say that the lingering disconnect in valuation expectations is still out there. That can create a lot of friction, often leads to stalled negotiations and sellers who haven't adjusted to, if you will, the new normal, which is constantly shifting on pricing, are finding it harder to close deals.
Yeah, those first two you listed are the ones I keep hearing a lot of, is any kind of friction around the financials and then having too concentrated of a client base. Yeah, those are the top two every time in my experience as well.
Absolutely. Got to get that QOV done early.
Yeah, right. So are you seeing any particular industries that are active right now?
Good question. There are a handful of sectors that are driving a lot of the activity. This probably won't be much of a surprise. Tech-enabled services, software remains strong, especially anything that's related to artificial intelligence, cybersecurity, cloud solutions, data centers. Healthcare technology has also been robust. With rising cyber threats, cybersecurity businesses are also popular. Cloud security, identity management, managed cybersecurity services. And then from a transaction perspective, there's definitely been an uptick in minority investments, growth capital, and joint ventures, which allow buyers and sellers to manage risk and still retain upside in uncertain times.
Good insights right there as well. I appreciate that. Let's kind of shift a little bit toward more of a macro look and kind of client facing. What's one piece of advice that you've been giving clients more often this quarter than you were in the prior?
Sure. I wouldn't say, at least for me, that it's new advice, but the advice definitely has greater urgency this quarter than in prior quarters, which is begin due diligence early and invest in pre-market preparation. That means conducting a quality of earnings analysis, shoring up compliance, addressing any skeletons in the closet before going to market. I also recommend that clients focus on current realistic pricing data and consider where they're willing to flex on deal terms. It's helpful to know that ahead of time. Sellers who come prepared and are willing to structure deals creatively are much more likely to close. So that might mean being open to earnouts, deferred payments to bridge valuation gaps for buyers. It's about negotiating contingencies that protect against downside risk. And I'm also emphasizing the importance of proactive communication and transparency throughout the process to try to avoid surprises that could otherwise derail deals. In short, adaptability and collaboration are key to navigating the current market dynamics.
Solid advice for sure. These are the reasons why people that are running their businesses don't want to go into this kind of thing alone, the transaction itself. So last question, let's look forward into the crystal ball. If you had to bet on one shift coming in the A space, what would it be?
Good question. In terms of a single shift, I don't know that I could necessarily zero in on one, so forgive me, but technology, healthcare, AI, they all command headlines right now. But I'd say there's a notable shift underway in the M&A market and the PE markets towards more traditional sectors, things that maybe had fallen out of favor for a while, such as infrastructure, nuclear energy, including SMR and fusion startups, consumer services, things with reliable recurring cash flows, especially like pool services, lawn care, plumbing, electrical, HVAC, pest control, those types of similar home services. And then, of course, US-based industrial and manufacturing. The reason why I say that is I think it's being driven in part by macroeconomic trends and government policy and strategic realignment by both buyers and private equity. Things like reallocation of capital, need for abundant, reliable, cheap energy, and cross-sector activity, basically targeting those traditional sectors for the digital transformation opportunities that are out there.
Interesting stuff for sure. That might warrant another discussion later down the road. I think
Sure.
a few of the points that you made were pretty strong. We could rabbit hole this all day. Steve, I appreciate your insights. For those of you watching, I hope you find this as valuable as I did. I think that was a lot of valuable insight in a short time. To find more insights from our Deal Pulse, you can check out our interviews on our YouTube channel as well as the LinkedIn, and you can visit the Vant Group. Steve, thank you, sir, for your time and your insights.
Absolutely. James, thank you so much for having me. Enjoyed it.